Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you the difference and help you decide whether or not you want to do the put credit spread or the call credit spread. Now, both of these option strategies are excellent option strategies for number one, if you're a beginner options trader, and number two, it works particularly well if you're trading with a small accounts portfolio. Now, both these option strategies are also known as income generating option strategies. So, if you want to learn how to grow your small account portfolio quickly, consistently, and safely over time, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to give you a complete walkthrough of the put credit spread and the call credit spread. I'm going to show you how to use both these option strategies in different settings. I'm going to show you the barriers to entry and how you could always come out on top with gains consistently to help you grow your account portfolio. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. Now, when we say we're going to get down and dirty with options, it simply means that we're going to be giving you a step-by-step walkthrough of each of these option strategies in order for you to be able to follow along with us. And if it does suit your fancy, maybe you might want to try this with your portfolio. Now, before we get into any of these option strategies, there's always requirements I have for my viewers and also my subscribers. Requirement number one is always going to be always make sure to do your own due diligence before investing. What may work for my portfolio, quite frankly, may not work for you. The second requirement is going to be always make sure to have an exit strategy before entering any options trade. That way, if the trade were to go against you, then you know how to get out of the trade. That being said, let's go ahead and jump into these option strategies. For today's video, we're going to be using the ETF SPDR or the Spider ETF, and that ticker is going to be SPY. So let's go ahead by going to Trade SPY options in order for us to open up the option chain. Now, what we're going to do, we're going to go ahead and start with this first option strategy. Now, I usually like to start with the put credit spread because the put credit spread just helps me determine what other option strategies I want to do. When I make the second video after this one, that's going to help you see why I actually like to choose the put credit spread. Now, we're going to go ahead and get into this. We're going to go first to sell. We're going to go to put. And now we're going to go ahead and choose our strike date. The strike date is of key importance, especially with this ETF that we're trading. So if we go ahead now to the drop down, you're going to see that the Spider ETF have daily expirations. Now with daily expirations, you could feel free to go ahead and choose any one that you want. However, just for the purposes of this video, we're going to be doing what's called weekly options. So we're going to look for expiration that expire every week. So that's going to give us July 3rd, which gives us 7 days to expiration. Let's go ahead and click that one. Now, we're going to go ahead and implement the first leg of this two-leg option strategies. Now, bear in mind, I'm going to keep this video as beginner friendly as I quite possibly can, while giving you information necessary in order for you to go ahead and practice this with your own portfolio. So let's go ahead now. Now that we have the sell, we have the put, and we choose our required expiration date, now we're going to go ahead and choose our strike price. In order for this option strategy to be the most effective, it's highly advisable that you choose your strike price below your share price. The current share price is at $611.94. Now, the share price might be fluctuating just a tad because it's after hours. The market is still fluctuating just a bit. So we're going to go ahead and choose our strike price. Now, the criteria for me choosing my strike price is going to be based on my chance of profitability up here. So what I'm going to look for is a chance of profitability of 75% or higher. So we're going to go ahead and go down. So here's a 75% chance of profitability right here. Now, the reason why I'm choosing a 75% chance of profitability is because the market usually goes down a lot less than it goes up. So I'm fine with a risk of 75% chance. What a 75% chance of profitability tells you is that there's a 75% chance that this trade is going to work out in your favor. Now, with the 75% chance of profitability, that gives us the 607 strike price right here. Now, because this is a sell option strategy, we're going to get paid But remember, this is only the first leg of a 2-leg option strategy. We're going to go ahead, we're going to click into that. Now, the amount we're going to get paid for this first option strategy is going to be $2.16. Bear in mind, each option contract does contain 100 shares. So you simply multiply your 100 shares by $2.16, and that should give you the gain of $216. So once again, this first option strategy, we're going to be getting paid. Now, if you guys are more or less risk tolerant and you guys need a higher chance of profitability, then feel free to keep going down the line until you get a chance of profitability that actually suits your fancy. Remember, this is just for purposes of this video. Everyone has their own risk tolerance. Now that we have this first leg, now we're going to go ahead and implement the second leg to make this trade complete. So now we're going to go to buy. We're going to leave put, and we're going to leave the exact same strike date. Now, of key importance, we're going to go ahead and we're going to choose the strike price right below the first one that we choose. This time, we're not looking for a chance of profitability. We're just going one strike price below our previous strike price. We're going to go ahead and we're going to click into that. Now, this time, we actually buying. So because we're buying, we're going to have to pay. Now, the difference between what we receive for the first leg and the amount we have to pay for the second leg is going to give us some income. That income is going to be right here, 0.22, but let's go ahead and hit continue. So that income is going to be $24.92. Let's go ahead and round it up to $25. Now, this first option strategy is known as the put credit spread. The put credit spread is good for two reasons. The number one reason is that it's an income generating option strategy, meaning as soon as you do this option strategy, you will be getting money in your portfolio. That money is yours to keep no matter how the trade goes. The second reason why this is a very good option strategy is because it caters to beginner option traders that do have small accounts. So the barrier to entry for this particular option strategy is only $100. That's what you're going to have to leave as collateral. So anyone trading with an account value of $100 could very well go ahead and implement this option strategy. Now, the reason why I wanted you to choose the strike price right below the first strike price is because I wanted you to choose what's known as an option spread of $1. The option spread of $1 is going to determine how much collateral you're going to want to leave. So the difference between 607 and 606, that's going to give you $1. You multiply your $1 by 100 shares, and that's going to give you your collateral here of $100. As opposed to, had you gone now and you go ahead and choose the 605, let's go ahead and show you how that works out. Then now your option collateral is going to go up by an additional $100. So small accounts portfolio, feel free to choose whichever spread suits your fancy. The bigger the spread is, the more likely are you to win the trade. But the bigger the spread, the more money you're going to need to leave as collateral. So we're going to stick with the first one. So with the put credit spread, the put credit spread is a bullish option strategy. So if you're of the mindset that the stock market is going to continue the price where it's trading at currently, or it's going to go up, or if it does come down, it's just going to come down just a little bit, then the put credit spread is going to be right for you. Now, how does the put credit spread work out? Come expiration date. In this case, it's going to be July 3rd. If this share price here stays above your 607 right here, then you get to keep this $25. Remember, this $25 is yours to keep no matter how this trade go, because this is an income generating option strategy. Now, in addition to you keeping your $25, you're now going to have your $100 of collateral released back to you. Now you have that $100 collateral released back to you. Now you could go ahead and probably do a second trade for the next period if you so choose. Now, the other way this trade could go, come again, July 3rd, expiration day, if this share price right here happens to go below your 606, then once again, you're going to keep your $25. I mean, income generating, you always get to keep this income that you receive firsthand. Now, you're going to get to keep this. However, you're going to be losing your collateral that you left. So remember, I just showed you How you choose your collateral. You could either go one wide spread or you could go two wide spread. It's all going to depend on you. Now, the amount of money you're going to be losing is going to be $100 off the bat. However, that is not the actual amount of money you're going to be losing. The actual amount of money you will be losing is going to be the amount of credit you receive, which is going to be $25, minus the amount of money you put for collateral of the $100. So the amount of money you're actually going to be losing is only $75. Now, a third reason why the put credit spread is loved by many investors is because of the amount of gains that you get. So you only live in $100, but you're going to receive $25 right away. That represents a gain of 25%. Now, for those of you not familiar with options trading, a 25% gain is extremely large. Now, if you're not comfortable with such a large gain, then in order for you to mitigate this, all you need to do is choose your strike prices lower, or to make it easy, you go ahead and get an even higher chance of profitability when choosing your first leg. So there you have it, the put credit spread. The put credit spread is perfect for beginner option traders and also people with small account portfolios. The put credit spread is an income generating option strategy, a bullish option strategy that allows you to get money as soon as you do the option strategy. So if you're bullish, you could consider the put credit spread. Now, what we're going to do, we're going to go ahead and we're going to jump into the other option strategy, which is the call credit spread. After you see the call credit spread, then and only then can you decide which one you feel most comfortable using. Both of them can be used. It just depends on your outlook of the market. Now we're going to go ahead and demonstrate the call credit spread. The call credit spread now is also a two-leg option strategy. So let's go ahead with the first leg. We're going to go to sell. We're going to go to call. And then we're going to maintain the 7 days to expiration because we want to do weeklies. Now, in this case, we're going to go ahead and we're going to choose our strike price above the current share price because that's going to give you your best option of this trade going in your favor. Now, the previous example, I asked you to look for a chance of profit of around 75%. And the reason for that was because the market usually goes up way more than it goes down. Now that you're doing the call credit spread, you're on the top side of the market. So now you're going to be looking for a chance of profitability that's a lot higher. So you're going to look for a chance of profitability of around 80% or higher. So you could start here with the 619, or you could choose any one of them above the 619. Now, this is not a rule of thumb. This is just my personal preference. Feel free to choose any chance of profitability that suits your fancy and also suit your portfolio goals. So with a chance of profitability of 80%, that's going to coincide with the 619 strike price. We're going to go ahead and select that. Now, this first leg of this option strategy is once again a sell option strategy because we're selling something. So we're going to receive some kind of income. The amount of money we're going to be receiving is going to be $121. Once again, you're going to multiply your $1.21 by 100 shares, which is one contract, and that's going to give you $121. Now that we have the first leg out of the way, now we're going to go ahead and make this option strategy come full circle by implementing the second leg of this two-leg option strategy. Now for that, we're going to go ahead to buy. We're going to maintain the call. We're going to maintain the expiration date. Now we're going to go ahead and choose the strike price right above the previous strike price we chose. Again, we're going to maintain just $1 widespread in order for our collateral to be as low as possible. So that's going to give us the $620 strike price. Let's go ahead and we're going to select that. Now this one now is a buy option strategy. So now we're going to have to pay. The difference in what we have to pay, which is $100, and the amount we receive, which is $121, that is what's going to represent the amount of credit that we're going to be receiving. Hence, this too is another income generating option strategy. Let's go ahead. We're going to hit continue. We're going to hit review, and voila. So the amount of money you're going to receive once you do this option strategy is going to be $23.92, or let's round it up to $24. Now, this $24 here, once again, that is yours to keep no matter how the trade goes. One of the most important things for the call credit spread is that The call credit spread, the barrier to entry once again is extremely low. The collateral in order for you to execute this trade is only going to be $100. So once again, perfect for small accounts. The other reason that makes it perfect for small accounts is that as soon as you execute this option strategy, you're going to be receiving some kind of income. In this case, $24. Now, this income may look small, but what you need to do is try to get this income as much as possible, because this here is what helps you grow your small account portfolio. Now, if you are trading with a big account, then all you need to do, you could do the exact same strategy, but now you have the ability to scale. So feel free to go ahead here and alter the amount of contracts. So instead of putting one, based on your portfolio size, of course, you could go to 2, 3, 5, whatever the case might be. Now, here's an excellent professional option trader tip that you should definitely listen to. Never risk more than 5% on any one trade. I mean, it is your portfolio to do whatever you want to do with, but that's just my professional advice. Don't risk more than 5% of your portfolio on any one trade. Now, this is the call credit spread. With the call credit spread, once again, you're going to receive income as soon as you do it. Now, how does this trade go in your favor? Come expiration date of July 3rd, if this share price right here is trading at any price below your 619 strike price right here, then that's going to be a win for you. And what happens when you win is that you're going to get to keep your $24 here. You're going to get your $100 collateral. That's going to be released back to you. And now you're able to go ahead and do this trade again if you so chooses. Now, before I tell you the other way this trade could go, let me show you how you could use this in order for you to be trading free money. The maximum amount you could lose on this particular trade is going to be $75. That's going to be the amount of credit you receive, which is going to be $24, minus your collateral, which is going to be $100. Now, the difference here should be, let's round it up to $75. So if you were to do this trade 3 times and you win, then you would now be able to make $75. Once you make $75, now you're going to be risking that $75 that you got from the stock market in order for it to go ahead and make additional income. So at that point in time, you're going to be trading with what we call house money. So you have zero risk in the option strategy that you're going to do once you gather that first $75. That does not mean you need to go ahead and scale to a lot of figures. Just always be careful when trading options. Options could go any which way at any point in time. Now, the other way that this trade could go, come expiration date once again of July 3rd, if this share price right here is now trading above your 620 strike price, then once again, you get to keep your $24. However, now you're going to lose your $100. But I just explained to you, the entirety of the loss is not going to be $100. It's going to be this $24 here. You're going to subtract that from your $100. So your loss on this trade is going to be $75. So there you have it, investors and future investors. The call credit spread and the put credit spread. The These are two option strategies that can be used if you're trading with a small account portfolio. Also, if you're new to options trading, it's a good way to learn options by not risking a lot of money. Now, the only difference in these two option strategies is that one gives you a bullish outlook, which is the put credit spread. The call credit spread gives you a bearish outlook. So there you go. That is going to help you decide. If you think that the market is going to be going down, then the right spread for you is going to be the call credit spread. If you think that the market is going to stay where it is or continue going up, then the right spread for you is going to be the put credit spread. Now, if you guys have any questions about these two option strategies I covered in this video, let me know in the comments below. When I just started options trading the first time and I too had a small account portfolio, I definitely utilized these option strategies every single week, and they really helped me learn options and helped me grow my account portfolio consistently and safely. Now, for those of you that made it here to the end of the video, you guys are the real investors and future investors. If anyone needs any help with options trading, I just want to let you guys know that I do offer one-on-one coaching, and that link is going to be the first one in the description below. Now, go ahead and like the video. Subscribe to the channel in order to get these videos whenever it comes out. Make sure to hit that notification bell. But here's the most important thing. If there's anyone out there struggling to grow a small account portfolio, then the best thing to do is to go ahead and share this video with them. We're trying to help as many as we can get away from the 9 to 5 by earning income with options. Now, until the next video, keep pushing your investments.